first guest this morning just forged its first international tie-up. That's a joint venture agreement with Japan-based real estate firm NTT UD Asia. The joint venture will undertake a 6.5 billion peso two-tower residential development at the Cebu IT Park with over 500 premium units. Tower 1 slated for launch before the year is out. Cebulan Master CFO Grant Cheng joins us live this morning. Hi, Grant. Long time no see.
Good morning, Mimi. Thanks for having me.
All right. Grant, the last time we spoke, I remember was in the middle of the pandemic. So I guess right. I want to ask, I'm curious, how is Cebulan Masters today? Are you already back to pre-pandemic levels? And just for context, last week we had Colliers on the show and they said that the Queen City of the South's office market will take a few more years to recover. But the residential and hospitality segments are already, in their words, aiming for an upswing. What is the sense you're getting as a developer there?
Well, the sense we're getting is that, especially since as a developer, we are more heavily into residential. To answer your first question, we've already fully recovered and in fact already exceeded our results from pre-pandemic times. The fact is there's just so much more housing backlog that we can serve into. It will take decades, not just for our company, but for the entire industry to even start making a dent into this underserved demand. That's underserved for many, many years already. The backlog just continues to grow.
How big is the backlog for Cebu?
In Cebu, it's roughly about, within Metro Cebu and Central Visayas, it's roughly about 1 million housing units. Put that in context, in our 20-year history, we built about 40,000 houses. And we're already the #1 residential developer in this region. That just gives you a size of how much more demand we should be serving into from the past, in addition to what we should be serving, going forward.
All right. And clearly the numbers are showing, when you look at your earnings report for 2023, pretty stellar performance. Consolidated net income up 29% to 4.6 billion. Revenue also up 20% to 18.8. Do you think you'll be able to sustain this momentum for this year, or are you expecting even better numbers in 2024?
Momentum. Yeah, we'll be able to sustain that momentum. I can state that quite confidently because one of the things I always try to articulate is that, in fact, our financial statements, based on PFRS accounting standards, is a lagging indicator of our business results from years past. And the reason for this is because our revenues and net income is based on percentage of completion. So just to put, what I mean by that is, even though I have fully sold out my residential projects, I am only gradually able to recognize revenues and net income on my financial statements as my developments go up and as percentage of completion increases. So as we deliver the building completion, we can then slowly recognize the value of the sales contract that we have already signed from years ago. So in fact, 2024, I already know how much revenues I should be recognizing just from the projected execution of my buildings. So this is all internal already. I already have the sales book in hand. I'm already collecting on those sales. It's a matter of accounting now of when I'll recognize those revenues and when I'll be able to monetize those collections and those contracts. So yes, the momentum will be there, and we're pretty confident.
Will the momentum be even faster?
It will probably continue at the same growth rate. It's already quite excellent. It's double digits. It's I think it's one of the best in the industry. So you also have to be cognizant of certain factors. You can't grow too fast in this industry. You might over leverage yourself. Input costs like inflation on steel and concrete might play a factor, and the increased cost of capital in terms of interest and equity raising costs. Those are things that factor in. So when you do grow, you have to grow in a sustainable way where you're able to deliver consistently and at the quality and execution that is expected.
Grant, you already mentioned some of the critical factors from macroeconomic numbers that are affecting you as a supplier and your buyers, your clients. Interest rates and inflation. What is your visibility for interest rates this year? How is that affecting your business strategy, for example, with the cost of borrowing expected to stay elevated but start, going down? And inflation, hopefully we're already, the worst is behind us. Is that what you're expecting as well?
Yes, it is. We have the same visibility as everyone else. I go to all the economic briefings of banks and digest the research. So in terms of interest rates, there's an expectation that interest rates might start tapering off, or the BSP might start cutting rates perhaps later in the year. It's a bit later than expected. But the bottom line, Mimi, on our business is that despite the elevated interest rates, you have to continue engaging the market because the demand is there. So while the interest rates are higher, and it means that our margins and our income may not be as high as we wanted it to be, the fact is to remain in the market and to continue to be in business delivering houses to people, we have to engage that cost of capital and just bake it and price it into our products slowly but surely. And what I mean slowly is because our product cycle is much, much longer than, say, that of a gas station or a grocery store. It's a 5-year cycle, right? So we have to slowly transmit these input cost pressures to our prices without destroying them. On the other factor, the inflation, the good news is that I think the worst is behind us in terms of the input costs in real estate. If you look at the nuance of inflation, most of inflation is now driven by food costs, our imported rice and sugar. But thankfully, if you look at steel and concrete and a lot of the materials that are going in, I think the worst is behind us. We've seen the peak of that inflation last year. And in fact, prices have gone down, and we've been able to stabilize our margins and pricing and our costing for our products.
All right, that's good to know. So you did say that a lot of these things are rear view mirror. Let's take a look at what's ahead. I know that last year you launched 10 new projects, 10, with a collective value of 18.7 billion pesos, around 4,200 units, with a sellout rate of 63%. And completed projects are already 97% sold out. I wonder, how does your 2024 pipeline look like? How many new projects are you launching this year, and how much collective value?
We're looking at around 12 projects this year. We're expanding into new markets like Butuan and General Santos. And we haven't been shy in saying that we have an eye towards expanding in Luzon. We're engaged with certain landowners so that we could start making inquiries and, in fact, making moves towards acquisitions and developments there. The total value of those 12 projects should be north of 20 billion.
North of 20 billion. Well, okay, that's much bigger. I'm sure our viewers are interested to know more about your Luzon targets. Are you in serious talks with anyone? Is this via JV, M&As? How soon? Is it happening this year?
It's brewing. I unfortunately I can't say much more than that. We're under non-disclosure agreements, but I will say the talks are serious. The intention is there. We've put in time and resources to explore some very serious and frankly some very exciting opportunities. We'll probably raise some eyebrows when they find out who exactly we're going to partner with and where. But before anything gets done, we want to make sure that anything that is confirmatory, before we disclose anything, is.
But will this be launched this year? This partnership?
As with any deal making, we hope it will. We're already in intermediate stages, I'd say, of some discussions. So hopefully an announcement this year. Yes.
And will it be in the residential space, or?
It will be anchored in the residential space. That is our bread and butter. That is what we know and what we do best. So anchored there, but always there's a consideration, especially for the kind of properties that we're looking at. There's going to be a mixed-use component. So commercial, perhaps hospitality and retail as well, given how prime the location could potentially be.
All right, but Grant, you're not just in residential. You're also into hotel operations and leasing. Talk to us about when you have a pie, for example, of revenues for CLI. How much would you say is coming from hotel operations, and how much from leasing? We know that hotel operations grew 66% last year. Leasing went up 42%, but 66 and 42% of what? Maybe a small base. How big?
Low base effects. So last year, those two segments combined made up about less than 2% for our revenues.
Wow.
We're still, our revenues and net income cash is still being driven by residential segment. So make no mistake that those are business segments we're still nurturing and we're still about. So just for context, right, it has grown and we're very committed in the hospitality industry. But the revenues you saw in 2023 were contributed only by 3 properties. 7 more are in the construction pipeline. So we do expect that the hospitality and the leasing components of our business will continue to grow as we diversify our product base as well as our cash flow profile. But it will take some time simply because the very base of our business, which is residential, is also growing. So everything is growing. So it will take some time before they catch up from a pie, from a percentage perspective, but it is growing quite significantly.
Is there a target that these two, for example, contribute maybe 10, 20, 30% to the total revenue?
Yeah, you hit the nail on the head. We're looking at 5 to 10%. But again, I'm not going to complain if our residential business segment is growing much faster, such that the growth of our commercial and hotel segments, even if they grow as fast, it will take some time for them to catch up. In other words, Mimi, just to use your metaphor, it's just because the pie is growing that much more faster as well.
No one's complaining with a big pie.
No, exactly. So even as the slice of our recurring income and hotels and retail and commercial components grow, that's part and parcel of an overall strategy to provide what we call synergistic values between our properties. So imagine, our residential offerings will become that much more valuable because of the convenience, as well as the convenience of having other types of properties around. And at the same time, if you're a commercial tenant, let's say, or a hospitality operator, hotel operator, there's value to be had in knowing that you're in a mixed-use development and can attract these kind of clientele.
And Grant, just very quickly, just a few more notes here. CapEx for last year was 12.9 billion. How much are you allocating for this year?
About 14 billion.
Slightly higher. All right, 14 billion. And you also have a follow-on offer. By the way, the offer period ends today, April 2. You're looking to raise as much as 5 billion pesos. Listing would be on April 12. So far?
We're already fully subscribed. With our main offering of 3. We're already into our oversubscription. And, we're already making strategic decisions on allocation because we've already exceeded our fundraising targets. We're already into the over allocation.
All right.
Segment.
This is a one and done fundraising for this year?
On the purchase or on the equity side, yes. But as with in real estate, we're a capital heavy industry. We're always in fundraising mode, whether bilaterally with banks or with other capital raising instruments. Perhaps, and I've mentioned this before, we are considering another capital raising activity towards the end of the year, but that's more from a capital structure management perspective and a liability management perspective, which is, in other words, if interest rates go down, we will very seriously look at refinancing some of our existing debt structure to take advantage of low interest rates.
And Grant, for those who are shareholders of CLI stocks, what do you tell them? I mean, it's not exactly...
I tell them first, congratulations. We just declared dividends of 8 cents per share. Right? So you wait for a couple of months, you'll get a little bit of windfall. The second thing I have to say is the stock is still very undervalued. I kid, it's a little bit of a running joke that, in fact, if I added up all of... Remember, Mimi, I mentioned something about our sales contract and that not all of the value of the sales contracts are reflected in our financial statements. If I just do simple math, it's this. If I collect all of my sales proceeds, I have enough to pay for all my debt, to pay for my market cap thrice over, and still have my recurring income investments, the assets that I have, the hotels, the land bank, for free. That's how undervalued we are. We're trading below book value. We're trading below price to earnings. But it's a matter of time. We're trying to get the message out there. We know that our primary job is to deliver results. And the best way we know how is to focus on our business and to continue delivering performance results. And then the market will just speak for itself. As Warren Buffett said, in the long run, it's a weighing machine, right? The stock market is a weighing machine.
And he also said, I remember, at one point that time will come when price will catch up with value. On that note, Grant, thank you so much. Always a pleasure to speak with you. I look forward to our next conversation.
Always grateful for your time, Mimi. Thank you.
All right.